Welcome back to Charisse Says. I'm grateful for the opportunity to take you to the next level when it comes to investing and give you practical money solutions so that you can have the wealth that you want. If you missed my last episode, don't stress. Check it out at www.charissesays.com. As always, I invite you to tweet at me as the show is going on. Did you know that according to the Investment Company Institute, retail investors, that's you and me, owned 89% of the nearly $16 trillion in mutual fund assets. Of retail investors that own mutual funds, about 9% also owned ETFs, or exchange traded funds. I want to get up close and personal with you today about mutual funds and ETFs because these vehicles are so important to your portfolio. And when I'm done explaining mutual funds and ETFs, you'll want to jump on it and invest in these vehicles. You might even be as excited as I am and want to dance like I'm about to do. I want the best for you because I've just danced for you. On the real, jumping on opportunity with mutual funds and ETFs can be one of the best financial decisions that you'll ever make in your life. I did it, and so can you. I'm going to cover two main points today. Number one, the basics of mutual funds. Number two, the basics of ETFs. And I'm going to focus on mutual funds and ETFs for stocks, not bonds or any other security. And I'm going to explain a lot of industry terms so that you become one smart cookie. Okay? Okay, let's get started. So, I want to start with mutual funds because even though you may not know it, you probably already have these in your employer's 401k or 403b retirement account. You remember getting that big old HR benefits and welcome package when you started a new job? Well, you probably also asked your friend to help you make those selections on where to put your money, or you did nothing. And those selections are most likely mutual funds. Don't stress. I'm going to make sure that you know what they are right now. In simple terms, a mutual fund is a financial vehicle set up by an investment company like T. Rowe Price, Fidelity, Vanguard, or JP Morgan, where I used to work. And that company issues shares and pulls your money along with thousands of other people's money and manages the investment on your behalf. Mutual funds offer three main benefits. Check these out. Diversification. Mutual funds allow you to put your money in many different stocks. You know the concept. Don't put all your eggs in one basket. Liquidity. Mutual funds offer easy access to your money whenever you want it, unlike if you make a real estate investment and cannot buy or sell it quickly. And professional money management. Most mutual funds are managed by people who are trained, like me, as chartered financial analysts, CFAs, to pick the stocks for you. Check out our previous episode if you missed our CFA discussion. When I worked at JP Morgan, I was one of those people who picked the stocks that went into the mutual fund that you would buy. A mutual fund is simply a vehicle that reflects a portfolio of stocks. This is great because each mutual fund has its own portfolio strategy that generates an expected return and has a certain level of risk. Many mutual fund managers try to generate returns above a benchmark, like the S&P 500 index, which I'll get to in 1 minute. First, I need you to know that you can buy and sell shares of mutual funds at a certain price called the net asset value, or NAV. For instance, let's just say that a U.S. mutual fund has a per share NAV of $25 at the end of the trading day, which is 4 p.m. Eastern Time in the United States. So, if you bought a mutual fund at 10 a.m. earlier in that day, you would actually get the mutual fund at its $25 NAV price, which is only determined once per day at the end of the trading day. This is an important trading concept to remember for mutual funds, so remember this. Many brokerage firms, however, require that you have a minimum investment amount, like $1,000, just to get into the mutual fund. So make sure you check that out. Now, you have the basics of mutual funds, specifically for stocks. Let's now talk about ETFs. In simple terms, an ETF, or exchange traded fund, is a financial security that tracks an index, which is just a portfolio of stocks that represents a specific market. Two of the most known stock indices that represent the U.S. market are the S&P 500 index, which reflects 500 of the largest stocks that trade on the New York Stock Exchange or the NASDAQ exchange, and the Dow Jones Industrial Average Index, which reflects 30 big stocks that trade also on the New York Stock Exchange or the NASDAQ exchange. When you buy or sell shares of an ETF, you're buying a portfolio of stocks that track an index's return and risk expectations. Indices are also known as benchmarks because they reflect the minimum return you should expect from a specific market. ETFs have become so popular over the last 10 years because of their ability to generate returns that mimic the benchmark. ETFs also have the same diversification and liquidity benefits as mutual funds, but you don't have managers that are actually picking the underlying stocks. And there's more: lower fees. ETFs tend to have low expense ratios, which is just the cost of operating the fund. My ETFs have expense ratios of 0.25 percentage point compared to my mutual funds that have expense ratios of 1 percentage point. Mutual funds have higher expense ratios because you're also paying for the manager, who can make millions of dollars a year just to potentially beat the market. So you might give up a little bit of return on your investment, but still get exposure to the stock market through ETFs, which costs less. And I say might because many mutual fund managers do not beat the market indices. Unlike mutual funds, ETFs do not have sales commission fees, known as load fees, which are charged just to get into a fund. And this is a plus for ETFs. Now, you can buy and sell ETFs on most of the major exchanges at any time during the trading day. This is important because you can buy an ETF just like a stock. So, if you pay $20 for an ETF, you spend $20 and own one share. Unlike mutual funds, however, ETFs do not have any required minimum investment amounts. So, your next question should be, Charisse, how do I pick good mutual funds and ETFs? Well, you can pick good mutual funds and ETFs in your brokerage account, and I give you guidance on how to do this on my blog. Or you can talk to your human financial advisor. Finally, you can get a robot advisor and these have become very popular over the last few years, robo-advisors pick a basket of ETFs for you. And we're gonna get to robo-advisors next week. And this wraps up our show for today. You've learned two important things. One, the basics of mutual funds, and two, the basics of ETFs. And now that you know the basics, you're ahead of the game. Jump on it and invest, people. You don't want to get me dancing again. Feel free to continue this conversation on Twitter and leave a comment or question on my blog at www.charissesays.com. Until next time, I say, keep building the wealth.